Why is Sharia-compliant liquidity management difficult for Islamic finance? Imagine trying to run a business without using any of the usual tools everyone else relies on. That's similar to what Islamic banks face when managing liquidity. As Islamic finance has grown rapidly in recent years, understanding why liquidity management is so tricky becomes even more important. Islamic finance is based on principles from Sharia law, which strictly prohibits charging or paying interest. This means Islamic banks cannot use traditional money market instruments like treasury bills or interbank deposits that pay interest. These tools are the backbone of conventional liquidity management, helping banks balance their short-term cash needs easily. Without them, Islamic banks need to find alternative ways to handle their cash flow. One big challenge is the lack of a well-developed Islamic money market. Unlike conventional markets, Islamic money markets are still growing and have fewer tradable short-term instruments. Islamic banks often relying on products like commodity Murabaha, which is a sale contract based on a commodity, or short-term Sukuk, which are lease-based securities. These options are more complex and costly to use, making liquidity management less straightforward. Another issue is the differences in how Sharia law is interpreted across countries. Some countries have strict rules, while others are more flexible. This creates a fragmented landscape where Islamic banks cannot easily operate across borders or standardize their liquidity products. It's like trying to fit puzzle pieces from different sets together. Islamic banks also face balance sheet mismatches. They often have assets with fixed repayment terms, but their customers can withdraw demand deposits at any time. Without access to quick, interest-free borrowing options, managing these mismatches becomes more difficult. Many central banks do not offer Islamic-specific liquidity support, which adds to the problem. Some countries, like Oman, are starting to develop Islamic liquidity tools such as Islamic certificates of deposit and Islamic treasury bills, but these are still limited in number and scope. Profit and loss sharing is a core feature of Islamic finance, but it's not ideal for short-term liquidity needs. Since returns depend on investment outcomes, Islamic banks can't quickly convert investments into cash, unlike interest-based instruments that provide immediate returns. This makes it harder to meet urgent cash requirements. In practice, Islamic banks often turn to interbank arrangements with other Islamic banks or their parent companies. These are usually based on profit-sharing contracts like Mudarabah, but they are less flexible and less liquid than conventional interbank markets. Overall, the main reasons for these difficulties are the prohibition of interest, the underdeveloped Islamic money markets, limited product options, differences in legal interpretations, and the structural issues within Islamic banks' balance sheets. These factors combine to make liquidity management a complex task for Islamic financial institutions. As the industry continues to grow, efforts are underway to develop better Islamic liquidity tools, but the challenges remain significant.